You're watching CFD Trading Insights. I'm Mark Lowerty. Alex Douglas from City Index joins us once more. You know, City Index is one of those CFD providers which has done a lot of education of the market. And one of the questions you constantly get is about risk. How risky is it and how can you mitigate your risk?
You know, it's very interesting actually. Risk is one of the few areas that you do actually have some control over when you're trading. You can't obviously control which direction the market goes in, but by selecting the correct position size and determining where you place your stop loss orders, you do actually have some control over the amount of risk that you take on. I guess from this point we should talk about the different types of stop loss orders. There are regular stop loss orders and there are guaranteed stop loss orders.
What's the difference?
Well, there are two types of stops. Probably the best way to explain them is to have a quick look at an example.
Okay.
Let's have a look at this stock here. Now, suppose for whatever reason you've been watching this stock, which has been more or less chopping sideways. But in the last week or two, you've managed to convince yourself, for whatever reason, that you think there's a bit of an upward trend emerging. So you see the stock on this day, looks okay, see it again the next day, and it's risen to $4.27. You think, okay, great, I'm going to buy some of this stock. So now you have a long position. You may be looking for a place to place your stop loss order.
Right.
If you look at the price action there, you see some lows at $3.90. If you're fairly conservative, you might place your stop below there, maybe at $3.87 or $3.85 in that region. You may be a little bit more aggressive, and you may look at this chart and notice that the 410 level has offered a bit of support and resistance over the last couple of months. So you might think, all right, I'll place my stop just below 410. Let's, for the sake of this example, say we've placed a regular stop loss at $4.05, $4.05.
And that's what we see there with the red line.
Marked by the red line, yes. So the next few days move along, market dips back a little bit. That's okay, we're still in the trade. We've got our long position and we haven't hit the stop loss. Next day, market dips below 410, but it's still above that stop loss and managed to close above 410. So you might be thinking to yourself that everything is still okay. The next day comes along, and unfortunately, the market had a very bad fall on that day, closed at 365. Now that's bad enough. We'll come back and talk about what happened to our stop in a minute. But if you're the type of person that gets home and monitors the price action from that day to make your decisions for tomorrow, if you got home and saw this price action and then decided to ring your broker and say, get me out tomorrow morning, unfortunately, the very best price you would have got on the open would have been $3.49. So it would have been a fairly bad day for you. Now, returning to our example here, we're long at $4.27. We had our stop, a regular stop loss in place at $4.05. Unfortunately, a regular stop is simply a trigger to execute the order. So if you have a long position and you've got a stop loss in place, obviously that stop loss is an order to sell.
Yes.
And if your order to sell is placed at $4.05 as in the form of a stop loss, when prices cross over $4.05, that triggers your order to sell. And unfortunately, in a case like this, you get slippage. And the best price you could have got here would have been $3.90.
I see, because it didn't actually trigger at $4.05. It kind of jumped over that.
Well, it triggered, but it didn't execute there. So if prices trade at your stop level or cross beyond your stop level, that triggers the order, and it then becomes a live market order to be executed at the next available price, which in this instance was the opening price of $3.90.
Right.
So clearly, slippage is something you wish to avoid if you can.
Because you've lost, in this case, 15 cents on each share.
Even though you had a stop loss in place.
Yes.
Now, from time to time, this can happen. You can avoid it by using a guaranteed stop loss. So if this stop loss was in fact a guaranteed stop loss at $4.05, then you would have been guaranteed to get your order filled at $4.05 no matter where the market opened up. So in this instance, market opened at $3.90, but because your order was guaranteed, you would have been getting out at $4.05. Now, if we have a look at a little bit of a table here, it shows how all of this works. When you entered the trade at $4.27, let's suppose you bought 5,000 of this particular stock as a CFD,
right.
Your portfolio value was $21,350. If you had a guaranteed stop loss there at $4.05, by the time prices hit $4.05, the value of your portfolio had dropped to $20,250. You paid a small premium on this particular stock of $141.75. Now, this is actually calculated as a percentage of the face value of the trade. In this instance, it's 0.7% of the face value of the trade at the guaranteed stop loss level.
I see. So in essence, you're paying a price, I guess, for that guarantee.
Exactly. It's like buying insurance.
Right.
So you're paying a small premium to place a guaranteed order, to be certain that you will get out at the price that you nominate. Now, with our guaranteed stops, you only pay that premium once when you place the order. You're then free to move the guaranteed stop level as often as you like without paying the premium again.
On that
particular order. There are certain parameters that the stop has to be a certain distance from current market prices. You'll find all the information about that on the individual securities market information sheets on the trading platform. Now, if you just had a regular stop in place and you suffered that slippage down to $3.90, at $3.90 the value of your 5,000 CFDs would have been $19,500. And if you were that person that got home at the end of the day and reviewed the price action and then made your order for the following day and you got out at the opening price down there of $3.49, the value of your 5,000 CFDs would have been $17,450. So you can see there the varying profit and loss. In fact, it's all losses on this particular trade. But if you'd been using the guaranteed stop at 405, you would have had a smaller loss than if you'd been using a regular stop at 405 and had suffered the slippage. So in this instance, you would be $608 better off by having used a guaranteed stop.
Right. So the premium, while costing you some, certainly seems to have paid dividends.
In this instance, it has, yes. If there's a possibility for a large move such as this in a stock, then it certainly is a valuable tool to have. One of the good points about the guaranteed stops with City Index is that you can place a guaranteed stop any time that the underlying market is open for trading. You don't have to place the guaranteed stop at the same time that you place your initial order. So you can have your position open for a week or two, and then if you're making some nice profits, you can come along and, provided the market is open, place a guaranteed stop on it to protect any open profits that you may have.
Thank you very much, Alex Douglas. And you can interact with us through this website. Click Apply for a demo account to try the City Index platform risk-free and discover the features of the live account. Or click here if you want to jump right in and apply for a live account straight away. To learn more about CFDs, download the 10 Golden Rules of CFD Trading by clicking here, or ask us any question you like about CFDs through this form.
You should read and consider the PDS before making any decision to deal in City Index products, which are derivatives. Derivatives can be highly leveraged, they can carry a high level of risk and are not suitable for all investors.